Hello, and thank you for joining us for this World Council of Credit Unions virtual event, Credit Unions and the G20, the push for financial inclusion. My name is Greg Newman, Director of Communications for World Council of Credit Unions. This year, the International Credit Union Movement has been urging the G20 to focus on the importance of proportionality in regulations for smaller cooperative depository institutions such as credit unions to greatly reduce inequalities and promote inclusive growth. We believe that proportionality, if applied appropriately, can significantly advance the G20's goals of promoting financial inclusion by fostering responsible finance through increased access to affordable financial services. Today is really going to be a discussion about that effort and why it is so necessary. We're going to hear from Alyssa McCarter-Laborde, President and CEO of World Council of Credit Unions, Michael Lawrence, CEO of the Customer-Owned Banking Association in Australia and Treasurer of the World Council Board, Ryan Donovan, Executive Vice President and Chief Advocacy Officer for Credit Union National Association here in the United States, Michael Hatch, Vice President of Government Relations for the Canadian Credit Union Association, and last but not least, Andrew Price, Senior Vice President of International Advocacy for World Council. We are providing Spanish interpretation services for today's webinar. You can select that option by clicking on the interpreter button at the bottom of your screen. Tómese un momento para hacer clic en interpretación y elija si idioma inglés o español. If you have any questions for our speakers, please use the Q&A button at the bottom of your screen and type them in there. I will be asking them as time allows, but we do want to get to as many of them as we can today. And also, today's webinar is being recorded. It's going to be available later today on the World Council YouTube channel. That is at youtube.com/WOCCU. Well, I now have the pleasure of introducing a new face to many of you, World Council's new President and CEO, Alyssa McCarter-Laborde. She started with us in August and brings more than 20 years of experience leading organizations in delivering financial services across the globe. For the previous 12 years, Alyssa served as the Chief Executive Officer of Vitus Group, a for-profit holding company she established under Global Communities, an international development and humanitarian aid organization that operates in 27 countries. She has more now on why World Council and its member organizations moved in 2021 to approach the G20 about emphasizing proportionality as a key driver toward financial inclusion through credit unions. Alyssa, welcome.
Thank you. Good morning, good evening, everyone. I'm Alyssa McCarter-Laborde, CEO of World Council of Credit Unions. I'm new to the movement, but really a pleasure to be here and to give just a few opening remarks. World Council advocates on behalf of credit unions around the world, and we place particular focus on the international standard setting bodies. Our goal is to make sure that credit unions and the non-cooperative structure are adequately considered when those rules are established. And often what we see is that rules are designed for large international banks. So World Council works on your behalf to make sure that credit unions are considered. So that is what we are here to discuss today and to share our collective advocacy efforts around the world. You may be asking, what does the G20 have to do with me, with my credit union? So just to set a little bit of all of us on the same page, the G20 is a body where leaders from around the world come to agree on many different issues, and they give direction to the international standard setters on what their agenda should be, what that focus should be. So when we say standard setters, we mean the Basel Committee, the Financial Action Task Force, the Financial Stability Board, and others who were governed by central bankers, by finance ministers, other supervisory bodies from around the world. And this is how countries come together to set standards. And this is why we need our voice at the table. So our ask is clear. First, we need proportionality in regulations. And second, we need the acknowledgement that this is a key enabler of financial inclusion. So first, just for definitions, what we mean by proportionality is giving proper tailoring, or you could say right sizing of regulations for credit unions and other smaller financial services providers. It's not giving an exception. We want proper, safe, sound regulations, but we want rules that allow the cooperative model to work properly. And while international standard setters, Basel and others, have embraced proportionality, WOCCU has been successful in incorporating that into the international standards. What we see is that national regulators, national level regulators, often feel that they either don't have discretion to tailor those regulations to their local context, they don't have good capacity, they're often hesitant. And so what we see is that at the national level, it varies widely. Some are better than others. Some do not tailor regulations at all. And so that idea of proportionality, of right sizing, gets lost. That brings me to my second point, financial inclusion. That is why we are here. And the reason why proportionality is so important is because it enables credit unions, other smaller players who are inclusive finance providers at their mission, where we are trying to offer responsible and affordable financial products to rural, to underserved markets. Those are expensive to reach. Reaching rural populations is expensive. Burdensome regulations are also expensive. And so credit unions, by our mission, are agents for financial inclusion. And this is in line with the G20's objective to reduce inequalities, to promote inclusive growth. We are providing crucial financial services, things like agricultural loans, loans to SMEs, to marginalized groups, to other members of modest means. They are underserved by large commercial banks, but what we see is many of these regulations are designed for those large commercial banks, and that's often an impediment for credit unions trying to serve these markets and reach these kinds of customers. So conclusion here, World Council's ask of the G20 is for the international standard setting bodies to work with national level regulators on proportionality and to provide frameworks that let the cooperative model continue to serve those more vulnerable members of our communities. The good news is that we have had success so far. This year, the G20 is being led by Italy. The governor of the Bank of Italy, Mr. Ignazio Visco, has publicly stated that the G20 intends to include a menu of policy options addressing financial inclusion gaps, and that there will be financial inclusion language in the leaders' declaration that will come out at the end of October. So that's great news. Let me end it there in my brief remarks here and turn it over to the other panelists who will share with you more how they have been working on these kinds of advocacy efforts and how this focus is important in each of their respective countries. Thank you.
Thanks, Alyssa. I have to say, as someone who's only been here about 6 weeks or 7 weeks now, that's a pretty good grasp of what we do and what we're trying to do internationally. So thank you so much for that. I want to turn now to Mike Lawrence. He's CEO of the Customer-Owned Banking Association. That's World Council's direct member organization in Australia. Mike also serves as treasurer of the World Council Board. You know, Mike, we spoke last week and you mentioned that a meeting you, Ryan Donovan, and World Council International Advocacy representatives had with the secretary of the Basel Committee on Banking Supervision back in 2019. You said to me at that meeting that some of the comments that were made by the head of the Basel Committee that day are why we are now seeking help from the G20 on proportionality. Can you start by talking about that?
Yes, I can. Certainly, Greg. Thanks very much, and hello to all my colleagues around the world. Yes, I had the opportunity back in 2019 to meet with the Basel Committee. Well, not the committee itself, but the Deputy Secretary General, Ryan, who's on today's webinar with us, and you'll be hearing from Ryan shortly, and also my other colleague, Martha Durden from Canada, and the three of us met with the Deputy Secretary General to discuss proportionality because it is an issue globally where smaller players are disproportionately impacted because of regulation. And I think that we had a wonderful hearing and meeting. We covered a lot of ground. But the one thing that really stuck with me was the comment that he made that we, the Basel Committee, exist to regulate international banks. What your regulator does with your domestic banks is entirely up to them. So that was quite concerning, because our experience, as it is with many parts of the world, is that the local regulator is not proportionate, they're not implementing proportionate regulation, and it is taking the Basel recommendations and just applying it equally. So that was that then led to us in one of our strategy sessions at WOCCU talk about, well, who does the Basel Committee get its writing orders from? And clearly that is the G20, and that is where we're sitting today. Just to put a little bit more context around proportionality for us here in Australia, I've got a slide I just want to share with everyone. And apologies, I don't expect you to be able to see the detail in this slide, but I think it'll give you a good sense. This is the amount of regulation that is coming our way in Australia to every one of our credit unions over the next 18 months. And it's from all the regulatory bodies, whether it be, in our case, APRA, ASIC, Treasury, the ACCC, government departments, if it's legislation, and it is an absolute blizzard of regulation. Now, again, that is applied equally to all banks, credit unions, what we call authorised deposit-taking institutions. And it's not targeted at its objective. It's not proportionate. It doesn't take into consideration size and complexity, and it's a one-size-fits-all approach. And if I look back, 30 years ago, we had nearly 350 credit unions in Australia. About 15 years ago, we had 150, and we sit here today with 65, and we are consolidating at a rate of about 5 to 6 a year. And a lot of that can really be pointed towards this cost of compliance that's just getting more and more for the credit unions, and they're drowning under the weight of it. And so what we are saying to our regulators here and to a government is we need to address this regulation. We need to address it from a proportionate perspective, but we need to also address it in a more coordinated approach, because it is impacting competition here in Australia, because there is every year there's less and less credit unions, and that is not good for competition. So that slide that I put up with all the regulation, we took that to the heads of all the leading regulatory authorities, to the government, to the treasurer, and we have discussed that, and we have talked about them putting together a regulatory grid. Now, all of our regulators sit under what is called the Council of Financial Regulators, and that is chaired by the Governor of the Reserve Bank of Australia, which is our central bank. And I had a conversation with the Governor about this magnitude of the regulation. I showed him that slide, which we call the Death Star. So if anyone's a Star Wars fan out there, it's a Death Star for us. And it was not lost on him in terms of the magnitude, because one regulator is not talking to the next regulator, who's not talking to the government, and everything's getting pushed down the funnel at one time. So we're asking for a regulatory grid. We want an online portal where every government department, whether it be Treasury or any other department, every regulator, to feed into this regulatory grid, so that we have any of our credit unions at any point can go in and look at what is coming down the pipe at any time, whether it's a paper for consultation, whether it's legislation to be implemented. And what that means is there's going to be better sequencing of the regulation, but also importantly, we can look at the regulation that is coming out and try to apply a more proportionate approach. Now, the really pleasing thing is that the governor of the Reserve Bank did take it to the Council of Financial Regulators. It had unanimous support from all the heads of every regulator, and Treasury here in Australia has now been tasked with a pilot to build this regulatory grid to create better coordination of regulation and then hopefully a better proportionality. But we're a long way from it. And therefore, the importance of us going to the G20 should not be lost on us. So, yeah, hopefully that gives you a little bit of insight as to why it's so important to us here in Australia. So thanks, Greg. I'll hand back to you.
Thanks, Mike. I think we all kind of laughed last week when you talked about the Death Star. So I think everybody else probably on the webinar enjoyed that comment as well. But it is appropriate when you look at that image and the amount of regulation. I want to go now to Ryan Donovan. Mike mentioned that he was also in Basel a couple of years ago with World Council. He's the Executive Vice President and Chief Advocacy Officer for Credit Union National Association, or CUNA, here in the United States. Ryan, you represent World Council's largest member. And I know one of the biggest concerns you have, and think others who do advocacy work on behalf of credit unions around the world likely have, relates to the question, does my government care about regulatory burden? And Mike just kind of referenced that as well, but how does that relate to this issue surrounding our efforts with the G20?
Yeah, no, it's a great question, Greg, and thanks very much for having me. I hope everybody is having a great day. Well, you know, one of the core principles of advocacy is really understanding your audience. And when you're working with policymakers, that means understanding what keeps them up at night, what gets them out of bed in the morning, and how the information that we have as advocates can play in their decisioning. In other words, how are you relevant to them? So yes, you know, it's a key question about, do they care? And really the question is, what do they care about? And for us, you know, the G20, the Basel Committee, international policymakers and standard setters in general are important because they set a tone in the global economy. And for US regulators, whether it's the Treasury Department, the National Credit Union Administration, the Consumer Financial Protection Bureau, FASB, the Fed, whoever is regulating credit unions, they are consciously or subconsciously taking cues from the global regulators, the global regulatory community, and they're applying them to US regulated entities like credit unions. And, you know, over the last couple of years, I've come to the conclusion that regulators really don't care about the burden that they're putting on their institution, because that's not what gets them out of bed in the morning. That's not what keeps them up at night. You know, they care about preventing another global financial crisis. They, in the case of the international policy setters, they want to make sure that they are preventing the collapse of large internationally active banks. No regulator has ever lost their job or been chastised by their government because they kept a financial institution healthy and sound. And you know, I think this is really why it's important to have World Council advocating for us at the global level. It's why it's important for World Council members to come together and take the message directly to the standard setters and policymakers, just as Mike and I did with Martha Durden from Canada a few years ago. Because these folks really care less whether small domestic cooperatives are impacted by their rules. And that's a huge burden for us to overcome at the international level. So part of what we tried to do in Basel, and I think what we're trying to do through our advocacy before the G20, is to show how those standards impact us, even if the standard setters don't intend for them to impact us, or, you know, say what our regulators do is of no concern to them. But in essence, when we come together as an international credit union community, we can make ourselves appear big enough for them to notice, but still small enough that perhaps we can not be impacted by their regulation. And so that's why the G20 language on financial inclusion and proportionality is important. It really represents the global community coming together to endorse the idea that one-size-fits-all regulation is counterproductive to financial inclusion. And the more that we can get these international standard setters, in this case, the G20, which is representative of many of our governments, the more we can get them endorsing this proportionality idea, the better chance that we're going to have that our regulators and our lawmakers implement proportional regulation. Now, this has had a significant impact here in the United States. And sadly, the story for United States credit unions is very similar to the Australian experience. And in fact, as we were talking earlier, we talked about how there are very few original ideas. We all borrow things from each other in advocacy. And Mike, I guarantee you I will be stealing that slide. So for my US credit union friends, a Death Star slide is coming to a presentation near you soon. But as we face regulation from multiple regulators at the federal level, you know, NCUA, the National Credit Union Administration, our prudential regulator, really has taken notice of other regulators' requirements. They've taken notice of what the banking regulators are doing, and they've tried to apply similar standards to credit unions. And so our effort is really to get them to tailor their rules to the risk profile and to the size of credit unions. And I bucket these this issue of proportionality as it impacts U.S. credit unions really into three different areas. The first is efforts that fail completely to recognize the difference in structure, size, and complexity of credit unions. And here for U.S. credit unions, there are really three prime examples. The first is CECL, the standard for expected credit loss that has come out from the Financial Accounting Standards Board. And it's based on an international standard set by the International Accounting Standards Board that's commonly known as IFRS 9. It was adopted after the financial crisis that was, of course, caused by the big banks, and it's designed for large banks that are riskier, larger, more complex than credit unions. The way that credit unions right now account for credit loss is adequate, and we can see that in so many different measures. Our government tracks a lot of this. Our insurance fund, the deposit insurance scheme that we have, has remained solvent. There's just a number of ways that we can see that credit unions in the U.S. Have adequate standards and are fulfilling their expected credit loss standards. There should be a lighter standard for credit unions. There are other models that are out there. And CECL is a terrific example of how proportionality has failed U.S. credit unions. The second example, of course, is the risk-based capital rule that NCUA is implementing. This is based off Basel III capital standards, again, which were designed for large internationally active banks, and that institutions that are way more complex than credit unions. We've worked very hard over the last 10 years, essentially, to try to get NCUA to tailor those rules so that they are less stringent and reflect better the complexity of credit unions. But frankly, even today, the risk-based capital rule that NCUA is implementing remains a solution in search of a problem. You know, NCUA, I think, also has missed the mark on stress testing. They looked at what the federal bank regulators were doing for institutions with over $100 billion in assets, and they've tried to apply something to credit unions just because they were seeing other regulators do that. Other regulators were imposing new stress testing requirements on these large institutions because they were systemically significant. In the US, the entire credit union system represents about 7% of the banking market. The total size of the US credit union system is less than each of the 5 largest banks in the US. We're not significantly systemically significant in this market, yet we're being required to stress test as if we were. So that first bucket is areas where our regulator has completely missed the mark on proportionality. Then there are areas where regulators and the law don't go far enough to recognize the differences in structure, size, and complexity of credit unions. You know, following the financial crisis, Congress enacted what's known as the Dodd-Frank Wall Street Reform and Consumer Financial Protection Act. And as part of that law, we were able to get included language that allows this new regulator, the Consumer Financial Protection Bureau, to exempt any class of entity from its rulemaking. This is the language that really gives this new bureau the ability to tailor its regulation. And where they have used this authority, they have not gone far enough, and it has had adverse consequences on credit union members. And I'll point one example out here, which was the CFPB's rule on international remittances. When the CFPB implemented this rule, they provided a very low threshold under which if you did fewer than 25 remittances per year as a credit union, you didn't have to follow the rule. When they implemented that regulation, half the credit unions that did international remittances left the market, leaving the credit union members that relied on those services to go to Western Union or MoneyGram or any of the companies that were the reason that there was a new international remittance rule. When you drive half of the market, half of the credit union market out of the market, that's not consumer protection. It's the opposite of consumer protection. NCUA has done some things to tailor rules. They have a focus on small credit unions that has some lighter exam touches, lighter accounting rules, lighter capital requirements for new credit unions. But the threshold for some of these efforts is way too low. They have a definition of about $100 million or under is a small credit union. We look at the wide range of size of credit unions in the 21st century here in the U.S. It's just it's a much too low of a threshold. The third area of proportionality is what I'll refer to as political proportionality. These are attempts that look like proportionality but really don't make any sense in the real world. And the first of these also was a part of the Dodd-Frank law that was enacted about 10 years ago. And it has to do with the authority of the Consumer Bureau to examine credit unions. And there's a threshold in that law that says if you're a credit union under $10 billion, the CFPB doesn't have the authority to examine you. That examination would be conducted by the National Credit Union Administration. I know because I was there, that $10 billion number was grabbed out of air. It was completely made up. And in fact, in the original draft of the bill, it was much lower. It was $1 billion. And it was only thanks to the advocacy that U.S. credit unions brought to the U.S. Congress that it was raised to $10 billion. But there's no scientific or economic basis for the $10 billion threshold. And what the impact of that is, it means that credit unions that are over $10 billion are treated just the same as the largest banks in the country. And then the second example of sort of this political proportionality, if you will, we're dealing with right now in the US Congress, where there's consideration of a proposal that would require credit unions and banks to report to the government on their members the gross amount that has gone into a deposit account and come out of a deposit account in a calendar year. The original proposal said if there's $600 or more that goes into an account or out of account, then that must be reported to the government. In a recent proposal, they have raised that to $10,000, but we're talking about gross numbers here over the course of a year. So it may look like a big change to go from $600 to $10,000, but the practical impact is no change. It doesn't really change who it affects, because if you are a wage earner in the United States making a minimum wage, it is highly probable that you're going to have $10,000 either go into your deposit account over the course of a year or come out of that account over the course of the year. So this is a huge issue. It's really important for us to remain engaged with World Council on this advocacy, because when regulators fail at proportionality or right sizing their regulatory impact, it hurts credit union members. And that's the message we've got to deliver to policymakers and lawmakers. Things like CECL or the risk-based capital rule, at the end of the day, they require us to put resources aside that could be used to impact members' financial well-being. We're making progress. Advocacy, as I always say, is a process. It's not an event, but there's a lot more work to be done. That work's made a whole lot easier as a result of World Council's advocacy at the international level, and by, as I said, World Council members coming together as we've done to affect a positive outcome. So Michael and Mike and Greg and Alyssa, thanks so much for having me on this, and I'm eager to answer questions.
Yeah, and thanks for saying that. You know, we do have a question and answer button, the Q&A button at the bottom of the screen. We will be getting to your questions a little bit later. We still have one more speaker, but if you do have questions that have come up while you've been watching either Mike Lawrence or Ryan, please put them in to the Q&A spot there and we will ask them later. Not all countries are the same, and I want to bring in Michael Hatch now. He is Vice President of Government Relations for the Canadian Credit Union Association. Michael, I know Canada is a little bit different because credit union regulations there are really set and enforced at the provincial level, and in some cases, you've said there is actual proportionality in place where some smaller cooperative financial institutions aren't seeing the same regulatory burden as larger banks, but this G20 issue is still relevant there as well.
Yeah, that's right. Thanks, Greg, and thanks to my fellow panelists for your very interesting comments. Canada is a bit different in a few ways. We have one of the world's most decentralized federations here in Canada. Our 10 provinces, our subnational governments here are quite powerful, quite influential, and they have the constitutional responsibility for regulation and taxation and the delivery of key services like healthcare to a degree that most other countries' subnational governments don't have. So in the credit union world, there's a little over 200 credit unions in the Canadian market right now, and all but 2 of them are regulated by the province in which they do business. For the past decade or so, there's been the national legislative opportunity for credit unions to choose to go federal and to choose to be regulated not by their province but by the national government. So that option exists. But only 2 have gone down that road. 2 more are currently in the process, but that's still only 4 institutions out of 220 some odd credit unions in Canada that have chosen to be directly regulated by the federal government out of the national capital in Ottawa, which is where I live. The rest are regulated by the provinces. So what that means is that in Canada, there's a bit of a patchwork. There's different rules in British Columbia on the West Coast versus Ontario or Quebec or some of the other provinces, depending on the route that their respective provinces have gone. Now, having said that, there's also a large degree of influence that comes from the national government. OSFI, the Office of the Superintendent of Financial Institutions, is the key national regulator in Canada, and they set the tone. They obviously directly regulate the large 6 federally regulated banks, which occupy, depending on how you slice it, close to 80% of the market for financial services in Canada. So we are quite concentrated in this country. But oftentimes the provincial regulators will just follow suit on all sorts of different rules that come out of the federal government. So, we do have an interesting sort of patchwork in this country. So, there are examples where proportionality exists, where credit unions are regulated somewhat differently than the large federally regulated banks. However, this is still a key issue for us, and it's still a huge issue for us, especially to the extent that more and more credit unions, as we feel in the future, perhaps the medium, longer term time horizon, do go down the road and choose to be regulated by the federal government. It will become a bigger issue for us at the national level. Because right now, because of the way that our industry is structured from a regulatory standpoint, at the national level, we run up against a combination of ignorance and, frankly, indifference, if I can use a bit of a strong term, where federal regulators are focused on the large banks which dominate the market here in Canada, and they don't really know, they don't appreciate the role the credit unions play. So we're constantly fighting against that. So to the extent that in the future, more and more credit unions decide to be regulated by the national government and not their respective provinces, that's going to become more of an issue. And I'll give you a very recent and relevant example of that sort of ignorance that we run up against, and the degree to which the national government is focused only on the large federally regulated financial institutions was during the pandemic. In the early days of the pandemic, as in a lot of rich countries, governments were scrambling to get benefits and cash support out to individuals and businesses, and the same was true, of course, in Canada. And there was a huge, suite of national level financial support programs that were rolled out when COVID hit a year and a half ago, many of which were delivered through the financial sector. And at first, the federal government really only was focused on the 6 big banks. They thought they could deal with 6 institutions, pull 6 levers, get money out to people who needed it, and move on. Which of course was a huge problem for us, because depending on what part of the country you're in, credit unions represent anywhere from 20 to 40% of the market. So we had to fight, frankly, tooth and nail early in the pandemic to ensure that credit unions were part of the mix with regards to delivering those pandemic relief programs. It was not an automatic thing, because again, the federal government is so focused on those big 6 federally regulated institutions, which of course are huge, internationally active financial institutions that dominate the Canadian market. One more point I'll make, and then I'll stop, is an important context for us is open banking, which other countries have run with, including some of the countries represented on this panel, and regulated and legislated. We're a little bit behind in Canada. We haven't brought a regulatory regime to open banking in Canada yet. It's been a long process. The federal government's working on it, but it's going to be interesting to see to what degree we can achieve some kind of proportionality, for lack of a better term, in the open banking space in Canada. It's very much expected that the large 6 federally regulated banks, of course, are going to be obligated to participate in open banking just by nature, by virtue of their dominance of the market. But what we want to make sure is that credit unions in Canada have the ability, but not the obligation to participate. Because as you can imagine, with 220 institutions in our membership, we run the gamut from very large, very sophisticated, huge organizations to very small. And not all of them are going to have the opportunity or the resources to be involved in the open banking framework on day one, whenever that may be in Canada. So that's going to be an interesting conversation over the next couple of years as the new government now, although it's the same government, but we did just have an election here last week in Canada, plots its course to hopefully recover from the pandemic in the next couple of years. So I'll stop my remarks there. Thank everybody for joining us here this morning or afternoon or evening or late at night, wherever you happen to be. I look forward to questions and to the comments from our other panelists. So back to you, Greg.
Thanks a lot, Michael. Yeah, it's really interesting to hear how much is done at the provincial level in Canada. It's something certainly here in the United States we're somewhat used to, but not to that same degree, for sure. We've heard from executives now in 3 countries with strong credit union associations that advocate on behalf of their credit unions, but I want to bring in World Council Senior Vice President of International Advocacy, Andrew Price, now, because Andy, who actually kind of put this whole thing together today, he was responsible for getting everybody in the same place at the same time. Andy, I know many credit unions don't have that strong national association advocating on their behalf sometimes, or they have regulators that really aren't as attentive to things as they are maybe in the US or in Canada. So I would imagine with proportionality being stressed at the international level with an organization like the G20, maybe it's even more important to them.
Yeah, thank you, Greg, and thank you to all the other panelists, and thank you to everybody for being on the webinar. It's a pleasure to be here. That's exactly right, and that's kind of the crux of the problem that we see is that interaction between the international standard setters and the national level regulators. Where we feel like there needs to be a lot more communication so that national level regulators can really understand the importance of tailoring regulations to let credit unions do what they do. And so let me back up for a second and kind of bring a little more context to what the international standard setters have done, and then relate that down to perhaps a smaller country or developing country. And kind of let me show how this plays out at that level. At the international standard level, they're really starting to do a good job with embracing proportionality. And Financial Action Task Force, I think, is an excellent model. They've really done a good job about including risk-based approaches in the regulation. That language is always in there. They put in language that says that no regulation should ever be so burdensome that it denies access to financial services to a consumer. That language is wonderful, and it's really what national level regulators need to look at. They have a document out on financial inclusion, which is fantastic because it gives examples of how tailoring can occur. I mean, particularly with items such as member due diligence or customer due diligence, which you have to do at account of, ways to do that in a simpler manner if the risk warrants that. Likewise, the Basel Committee is including proportionality. It's in there in the Basel III standards, and they're also clear that that standard is really designed for the large, internationally active, the big boy banks, if you will. The problem really comes when you get to the national level, and what we find there is that national level regulators are often hesitant to tailor regulations for several reasons. Number one, they don't want to be perceived by their peers or their neighboring countries or their fellow countries as being weak, or they don't want to be perceived as providing an exemption or watering down a standard to make it easier for somebody in the country. A lot of times they just really don't know how to go about it, and that's really where we kind of see the problem. We think there needs to be more education in that regard about how they can proportionally tailor the regulations. And you kind of heard several of our speakers allude to this. When we go to the international standard setters, they're kind of like, well, hey, that's up to the national level regulators to do it. We're regulating the big boy banks, and they kind of don't want to be bothered with it. Well, I mean, that's the problem. We need both sides of the coin, if you will, to be speaking with each other. And so let me bring it down to a smaller country. There's one country out there for anti-money laundering requirements has a requirement that a credit union have a minimum of 3 anti-money laundering officers. And in Europe, the average size of my credit union is around 11 million in assets, and very small. A lot of my credit unions have 3, 4, or 5 employees, and so a requirement to have 3 anti-money laundering officers in an institution that small, it doesn't make a lot of sense. Interestingly enough, what the credit unions do is they will appoint the 3 to meet the requirement, but then each of them only does that function 1 hour a week. And I mean, that's kind of a simple example, but it just alludes to the absurdity sometimes of the hoops that you have to jump through to really get to the same end. And I need to make the point, credit unions we're not asking for an exemption. We're not asking to not be regulated. In fact, we need to be regulated. We need to understand that's part of a proper, safe and sound functioning regulatory system, but we want those regulations to be tailored so that they work. And I mean, the anti-money laundering is a great example of that standard as well. Kind of bring it back to the G20, because the G20, I'm happy to please, is really focused on financial inclusion. And they're very receptive to this issue. And in fact, many of the leaders' declarations for the past several years have been focused on that. And the link between proportionality and financial inclusion is well documented. And I think a lot of the credit unions know that inherently. They know that not-for-profit cooperative model, where the profit isn't your goal, really allows you to serve a lot of the underserved and rural areas. And so I think what we're trying to do with the G20 is bring that home, say, look, the proportionality is really important because it's going to let the credit union, do what they do best in those markets that are, that are underserved. And so what I see coming out of the G20 is we know that the governor of the Bank of Italy has already stated this publicly. He says we're likely to include a menu of policy options that will focus on financial inclusion. We're likely going to see some direction too. There's a global partnership for financial inclusion that sits within the Bank of International Settlements, which is where the Basel Committee is as well. To focus on some of the issues. So we're really pleased with that, because that means this issue is going to be continued to be worked on, and we're going to continue to work at next year. It's in Bali, Indonesia is going to lead the Leaders Declaration, where we know financial inclusion is going to continue to be a big topic as well. If we're successful in this, I mean, that gap between the international standard setters, giving more direction to national level regulators, helping them understand how they can tailor regulations. I think there's going to be a good focus on that. And you know what? I mean, that's going to let you as a credit union really serve your members and hit those areas. So I'm very excited. I'm very excited about the work that our entire credit union community is engaged on this issue, and credit unions are going to be, they are the best at providing responsible financial services to people, and I want to see more of that happen. And with that, I will turn it back over. Happy to take questions.
Yeah, thanks, Andy. Boy, that example though really does really crystallize what some credit unions, and a lot of our members credit unions, are very small. So that example about the 3 AML people, compliance officers, is really interesting. So if everybody could come back on camera here, we do have some questions. I want to start with one, and this is from, I hope I'm pronouncing this name right. It's Misael in El Salvador with Faracases, our member organization there. And this is maybe depends on the country, but it's possible that there are probably some overarching themes that we could touch on here. He wants to know, or she wants to know, what are the critical points of the regulations that are out there that require greater attention that cooperatives need to be putting in front of their regulators to influence the application of proportionality. So are there some common themes across countries, across borders? And maybe Andy, if you want to start with that.
Yeah, there really are. I mean, Basel III. By the way, if you ever need to sleep at night, I would urge you to go read the Basel III framework. It's enormous. It's complex. I mean, there's all kinds of formulas in there that that is designed. It was put in after the financial crisis, right? Dealing with large international banks. If you ever adopted that full framework for credit unions, I don't know how you would do it. You need slide rules and accountants and all kinds of things that you have to do. I mean, so accounting, the capital standards are one that usually need to be tailored down. The accounting standards, Ryan gave the example of CECL, IFRS 9. WOCCU has a tremendous amount of work on that area, trying to make simpler approaches for credit union on that issue. And we're continuing to work with IASB. I mean, those are the anti-money laundering requirement. What you have to do at account opening. I mean, particularly when you're dealing with underserved areas who don't often have government-issued IDs. The amount of money they're bringing in is very small. Your risk is very low. Getting regulators to let you tailor that down so that you can actually open an account and serve members is an issue that we see. So in the anti-money laundering, the capital, the accounting standards, there's probably about a million other things I can probably rattle off, but I'll open it up for the rest of the group.
When I read that question, I took it to a little bit of a higher level. And I think one of the things that we find effective to a certain extent with our regulators is, pointing out the difference in operating motives between credit unions and for-profit banks. Banks obviously are for-profit. They exist for the purpose of making a profit for their shareholders. They use consumers and small businesses and their customers as a means to an end. For credit unions, the member is the reason that the credit union exists. And as a result, in theory, and I think in application, credit unions operate a much less risky model less riskier model than banks do. And that's important because, again, as we go back to what keeps regulators up at night is the fear of collapse, the fear of problem institutions. And so if we start with, we are inherently less risky than the for-profit model, at least that's, I think, the first step towards proportionality.
And a couple of comments from me. I mean, we've changed the tune a little bit from proportionality to competition. We're not dissimilar to what Michael said in Canada. We have 4 very large dominant banks here, and we are the competition, being the credit unions. But as I said, you know, when you 30 years ago, you're 350, you're down to 60. Where are we going to be in 10 years, let alone 20 years? So we're changing the conversation around the importance of competition. And we're starting to see that play out. And Andy spoke about the new capital framework. Now, we've been negotiating with our regulator on that front for the past 3 years, and we've now got proportionality into it. So they've now got a simplified model for any ADI under 20 billion. And that goes to operational risk. It goes to some reporting requirements. But more recently, one of the most pleasing things for me is that our regulator has chosen to deal with us in a way they've never done it before around cyber risk. So there is a standard over here called CPS 234, which is all around making sure that you've got all the checks and balances in place, you know, from all your third parties, from a cyber risk perspective. Now, normally what the regulator would do would be to write to every CEO and say, you have to have an external audit completed by X date. They have come to us as the association, and we are working on behalf of our 60 plus members, where we've gone to tender with audit firms to drive the price down. We're going to be running webinars to uplift the education as we go through a series of these audits. We'll be engaging the third-party vendors themselves, so there is some consistency of approach and efficiency in driving that down. It's a very different way of working. Yes, we need to do it, but we're doing it in an efficient and a less costly manner. And that's what we need. There's different ways to skin the cat, as they say.
If nobody has any other comments on that, I want to move on to talk a little bit about, you know, one of the things that seems to be overarching right now is the pandemic. And I wonder if any of you have seen any regulators move to, Andy, I know that you wrote recently to the Basel Committee and say, hey, advise regulators to, when they withdraw COVID standards, that they do it in a manner that is reasonable. But has this impacted credit unions, and will we continue to see it impacting credit unions on a regulatory front over the next however long this pandemic continues to last, whether it's another 6 months or 18 months? Andy, you're muted.
Sorry about it. Thank you. It's interesting to see, you know, what the Basel Committee in particular, when you see kind of what's coming out, they're kind of in a mode of, you know, we're monitoring the systemic risks out there, and if we need to take further action, we will. They're kind of in a we're pausing, keeping an eye out. They've passed a lot of relief measures for capital standards, accounting standards. The payment moratoriums, there's some relief in there as far as how you have to account for that. There's several other things, you know, but when they say they're monitoring, they're looking for big systemic issues. And my concern is, you know, the recovery from the pandemic is probably going to be different all over the world, depending where you are, access to vaccines, all of those kind of, I mean, and economic trends all of that kind of stuff. And so we early on said, to the Basel, please give guidance down to the national level regulators to give them a lot of flexibility as far as what they're going to do when withdrawing these relief measures. What we don't want to happen is for them to just say, okay, pandemic's over, take all these relief measures, and that creates additional shocks to the system. What we told them is let your national level regulators work with those local institutions. I mean, if they dipped into capital buffers, give them some time to rebuild that coming back. And it's particularly important for credit unions where rebuilding that may take a little bit longer. They're perfectly safe and sound and operating. They just may need a little more time to kind of recover from it. And so I'm a little concerned the Basel Committee doesn't understand, the difference of the credit union model, and so that's why we asked them to be flexible in that relief, to give the people at the local, at the national level who are in touch with what's going on in their country, to be able to tailor, how that plays out in the proper manner. So
one of the issues that we're now facing as a result of the pandemic, we were very successful in getting a lot of regulation put on hold. They across a number of regulators where they hit the pause button, but as we start coming out the other side, they all want to hit the start again button all at once, and it all comes down the funnel at once. And we have only in a couple of days' time, the 1st of October, we have we went through a Royal Commission, and I could talk for 4 days on the Royal Commission into banking here, but there were 76 recommendations that go through legislation, that go through regulators, and some of them are absolutely significant. We've got a whole lot of regulation that's coming effective 1 October. We've got design and distribution obligations 1 October. Michael mentioned open banking. There was no carve-outs for us. Every one of our members has to be a data recipient and signed up to open banking. Most of them have not met the timeline. It is the most complex project that has been going for years. The resources and money, and then you've got all these regulation taps being turned on again, and so it's becoming quite problematic. Whilst we were successful during the pandemic, we're paying the price now.
Yeah, Greg, you're asking a really good question. It's something that we were really concerned with from the beginning, right? So a lot of many of the accommodations that the government made at the beginning of the pandemic were tied to, in our case, the president's declaration of an emergency. And our concern last year was, for a while, that the president might declare the emergency over before it was actually over. Now, our concern is that many of the relief measures will actually expire before the crisis is over. And what we were trying to get our regulators to do was to say, whatever the day that the emergency declaration ends, provide a wind down period so that there's sort of an off ramp to this, so that it doesn't all end at one time. But what we're finding now is that period of time in some cases has already expired or will expire at the end of the year. And frankly, as recently as last week, our regulator has taken notice and encouraged credit unions, warned credit unions of the impact of the expiration of some of these accommodations, and told them to prepare for that. So it's tough to sort of figure out what's the best way to sort of off ramp some of these temporary but essential accommodations.
All right, thanks, Ryan. We're coming up here on the top of the hour, and I know there are a few unanswered questions out there. We'll try to get those by email to our panelists here, but I know, Alyssa, you wanted to make a few remarks before we close. Well, I think, Alyssa, we've lost her here, so we apologize for that. I do want to thank our panelists, Andy, Ryan, Mike, Michael, for all being here today. And again, I just want to remind everyone that if you like what you saw here, it was recorded. If you think others would benefit from this that weren't able to join us today, it was recorded and it will be available later today on the World Council YouTube channel at youtube.com/WOCCU. And we will have another webinar coming up on October 7th, if anyone is interested, and that is going to be on a little virtual global financial symposium with some representatives from the World Bank and also CUNA talking about some economic forecasting for 2022 and also the impact on credit unions. Thanks for joining us, everybody.